Dear friends, welcome to this session on how to read a balance sheet. Friends, financial statements basically comprises two important statements. One is the income statement, which can also called as profit and loss statement, and the other one is balance sheet. So when I say how to read balance sheet, I mean how to read balance sheet as well as the income statement. Now, what purpose this income statement and balance sheet serves? See, the income statement would give the information whether the organization or business unit is making profit or suffering loss, whereas the balance sheet would give the information on financial position of the business unit. So any business will be in existence to make profit and not to suffer loss, but whether they are making profit or loss, they'll be able to know only by preparing these statement, not by merely looking at the activities. So this statement has to be made, and this statement, the balance sheet, would tell what is the financial position of the business unit. I mean, what assets it has and what are the liabilities, who had funded all those assets. We are going to see all those in depth in these sessions. So now we'll see a little bit on income statement, that is profit and loss statement. See, the income statement would talk about all the incomes. Okay, it talks about all the incomes, whereas it will also talk about all the expenses. So the income statement, it is not only going to give you about income, it will also give you what are the expenses. And if income is more than expense, it is called profit, and if expense is more than income, it is called loss. So it's simple, it's very logical. And we'll see a little bit on balance sheet. See, balance sheet will talk about from where the money had come for the business, okay, and it will also say where those money have been used or how the funds are used. So any business cannot raise money on its own, because business is an artificial person. It has to borrow money from various parties, and only that money can be used in the business. So the balance sheet would basically tell you the various sources of finance. So what can be the sources of finance? One, it can be the owner's funds. Two, it can be bankers' funds, bank can give loan. Three, it can be suppliers' funds, where suppliers give you credit so you purchase goods. So what we'll do, we'll raise all these funds. These funds will be used for various purposes. One, it can be used for creating fixed assets. A big plant, machinery, factory, equipment, everything. And it can also be used for creating working capital assets. I mean, those assets which are necessary for day-to-day activities of the company. So now we have broad idea about what are liabilities. Liabilities are sources of funds, and uses of funds would actually create assets. It can be fixed assets and working capital assets. Now we have said owner fund is one source of fund. So owner fund would be in the form of share capital and reserves. So what is share capital? This is something which the owner gives directly out of his pocket, and reserves is something the profits earned by the business unit but not given back to the owners. See, owners are entitled to the profits of the business, but if they don't take the profits and they allow it to be within the company, within the business unit, it will be called as reserves. So owners funds can be two form. It can be direct and indirect. Direct is share capital and indirect is reserves. And again, bank loan also can be in two forms. One, it can be a short-term loan, STL. The other one, it can be a long-term loan, LTL. And supplier funds can be in the form of trade credit. Fine. So now we have a little bit idea on various sources of funds. And I was mentioning the uses can be for fixed and working capital. So what can be fixed asset? Say you use the money to acquire land, use the money to acquire building, use the money to acquire machinery. I mean, use the money to acquire various assets with no intention to sell but to use it in the business. So they'll become fixed assets. And what can be your working capital assets? Working capital assets are those assets which are required for day-to-day operations of the business. It can be cash, it can be the stock inventory which you keep for future selling or for future consumption. It can be bills receivables which will be created out of sales. What could be bills receivable? You make a sale to the customer, get bill from him instead of money. After some days you get money instead of that bill. I mean, you convert the bill into cash at a later date. So there is a promise from the customer, he'll pay you at a future date. And it can also be something like advances where you pay somebody. So this is a simple nutshell of balance sheet where you have the various sources of funds and uses of funds. We'll also see a little bit on income statement. See, as I told you, income statement would give you the information about your income, and it will also give you information about your expenses. See, income can be two types. One is from your sales, from your direct operating activity, and two, it can be from your non-operating activity as well. And expenses can be for both your operating and non-operating purposes. So the difference between these two, income and expense, can be either your profit or loss, and this is what we have seen in the beginning also.